Hi, I'm Pattu from freefincal. In this video, let's talk about what you need to know about gold before you start investing in it. So every time gold prices increase, everybody becomes an expert on the commodity. There's a lot of people saying, I told you so. Gold is always the safest asset. Why its value never comes down? It values always keeps increasing, etc. and so on. So that's not always true, and you should consider a lot of simple facts before you start investing in it. Now, we are not talking about buying gold for consumption, that is jewelry. That is not an investment, that is something that you want to consume. And at best, it will be a last resort emergency fund. That is when you don't have any other money, you will use it as a last resort source of funds and and sell that gold. And we will also not talk about accumulation of physical gold in the form of bars and coins. That is doomsday insurance. That is when the rupee fails, or when one plate of idli costs 60,000 rupees, then you can use gold as a currency because the rupee is worthless. But then how much gold will you have? And if until the rupee becomes worthless, if at all it does, I don't think it will. I hope not. Until and even when that happens, you will have to accumulate this gold, store it. The maintenance costs become a problem. The theft becomes a problem, even if it is in a bank locker. So it is not a very practical way of accumulating gold. So we shall limit the discussion to buying of gold instruments that track the price of gold, like gold funds, gold ETFs, gold bonds, etc. So we are talking about getting a slice of the return from because of the gold price movement. Of course, people want a slice of gold return, but they are not ready for the responsibilities that come with it. They are not ready for the implications that come with it. So that's what we're going to talk about in this slide. So first thing is, now this is a plot of the gold INR. The gold INR is in the left axis and the gold USD is in the right axis. They are of different scales, so you cannot compare them if you plot them in a non-log scale. We will see the log scale in the next slide. First of all, you can see in the oval that if you look at the gold has seen a bear market for several years, almost a decade, and in the 2010s, and even before that, during the 1980s and 1990s and so on, there were also a very big extended bear market. Of course, that such a bear market did not always come to be seen in the Indian market, that is in the gold INR segment. That is because of the exchange rate. Whenever the rupee was weak, it held up the gold INR even though the gold USD was falling. It is only from the 2010 onwards, that is the last 2 decades, we will see that the rupee has become quite strong, and there is a significant correlation in the price movement of both gold INR and gold USD. In fact, if you look at the rectangle, the last bull run, that is the bull run that has been around in gold for the last couple of years or so, that has been fueled by gold USD increase, and therefore the gold INR also increased. That is not because of a weak rupee. So what you should keep in mind is, as the rupee grows stronger, gold INR will start reflecting gold USD more and more. And if gold USD starts seeing a bear market, which it has seen in the past, and that such bear markets can last for years or even decades, then such thing will happen in gold INR also. It is not an asset which will keep on increasing, and that's just rubbish talk. I mean, people don't understand what they're saying. Now this is a plot of the same price movement in logarithmic scale, so you can now compare them in the same chart, and you can see in the 1980s and the 1990s up until 2000, gold INR was increasing while gold USD was falling. This was only because of the weak rupee. Of course, that was the time when our economy opened up. The gold INR USD exchange rate became priced according to international market forces and not a local fixation of the exchange rate, and therefore this price movement, the gold INR kept increasing even though the gold USD fell. But again, you can see from here, if you pause the video and see it, From 2000 onwards, there has been a good correlated movement in both assets. Now, many people assume that gold is a safe investment. It is absolutely not true. Gold is as risky as the stock market. And what you are seeing here is the 15-year rolling standard deviation chart. So you have some, let's say, those three lines. There are like 2000, 3000 points in those three lines, each of these lines, and each point in the line represents a standard deviation of the gold price over 15 years. That is, you take the gold price and you calculate how much it fluctuates over average over every month over 15 years, or even over every day. It doesn't matter too much how you calculate it, but the point is that the standard deviation, which is the volatility in the price of the Sensex, is the green line, the gold is the brown line, and the bottom line is the kind of a bluish gray line is the Indian long-term gilt index. You can see very clearly that the gold and Sensex are well above the sovereign gold bond index. That tells you that they are completely different from fixed income. And the gold volatility is only a little bit lower than that of the Sensex. It is almost as volatile. So you must not make the mistake that gold is a very safe investment. It is absolutely not. And what is shown here is called the maximum drawdown. So drawdown means, so you have a chart and there is a peak. So let's go back to this. Let's you have a chart and you can see that there is a peak here. Let's say at this point, I hope you can see the mouse, and or maybe here at the inside the oval, and then from this peak it falls down. So what is the maximum fall from this peak? That is about this point. Let's say it is minus 10%, 20%, 30%, whatever, and how long it stayed underwater. That is how long it stayed below the maximum. So that's what you measure using a drawdown. And what is shown here in black is the drawdown of the Sensex, and in red the gold INR drawdown. And you can see that although the Sensex drawdowns are very sharp, especially at times of market crisis, there are periods in which the gold drawdown is also very significant. You can see it's a fall of minus 20%, 25% is all possible in the past, and you can see how long it has been underwater. For example, if you see the red line here, in the 1990s to 2000, 1995 around to 2001, you can see it has been underwater. The gold INR has been underwater, which means it has been below a maximum. Same thing has happened in the 2010 decade. It has been underwater for several years. In fact, for 7-8 years between 2012 to 2017-18, the gold prices were underwater. That is below a maximum. So if you started investing and if you hit this underwater trough, then your returns will be down. So you can't say that it's a safe asset. The drawdowns are quite comparable, particularly the time underwater. You may not see huge drawdowns like during a market clash like 50-60%. Maybe not possible. I don't know. We don't know the future. But even if that does not happen, even if there's a 10%, 20%, 30% drawdown, if the drawdown extends for several years, then you are going to end up getting poor returns. So that is something that you should understand. Now what you see here is the rolling returns over 15 years of gold INR in brown and gold USD in white, and you can clearly see there is a huge difference in the returns up to about 2012-2013. This is because of the INR USD exchange rate, but that arbitrage has come down significantly since then. And you can also see even over 15 years, gold INR has often returned single digit returns, and even 6%, 5%, 7%, 8%, all those returns are possible over 15 years of investing in gold. So people who say it is a hedge against inflation, they are absolutely wrong. It is not a hedge against inflation all the time. Sometimes it will be, sometimes it will not be. Nobody knows that for sure. Same thing with equity. So please don't assume it's a very safe investment. It is complete nonsense. Don't fall prey to FOMO. Just because somebody is saying gold is increasing, you should have a slice of gold, or I regret not investing in gold. Don't worry about it. Look at the data and understand that it is an asset class that will go up and come down, and it can have several years of a downward moment. And in this graph, what you see on the pink is the USD INR exchange rate, and this is very important. The exchange rate was about 10% in the 1990s up to up to 2000, and then it dramatically fell down from 10% exchange rate over 15 years. So over a 15-year period, the exchange rate return was about 10% ish, about 9%, 8%, whatever, 9%, let's say. It fell down, and in the last 20-25 years or so, the 15-year USD appreciation over INR has only been 3%, 4% or so, maybe maximum 5% occasionally, but it has been 3 to 4% approximately. So you can see the big drop here. This has also been seen in the gold INR minus gold USD return difference. That also mimics this exchange rate, because that's how the extra return comes from the exchange rate. And what is very important is, on the right axis you can see the yellow line. The yellow line is correlated with the the right axis. The yellow line is the correlation coefficient between the INR and the USD prices. You can see the correlation coefficient swings between +1 and -1. +1 means perfect correlation, -1 means perfectly not correlated, no correlation at all. And you can see that the when we start tracking, the correlation start decreasing. It crosses 0 here and it actually becomes negative. There are periods in which gold INR and gold USD have seen negative correlation, then it becomes positive, and since then, since about 2009 2010 onwards, the correlation is very close to 1, which means that gold INR returns going forward is expected to mimic the gold USD returns, aside from a small arbitrage because of the exchange rate. What is very important is, if the gold USD sees a bear market, and it has seen several bear markets in the past, gold INR will also see the same kind of bear markets. The exchange rate arbitrage will not save us, because the currency has become very strong. So please don't assume that gold is a safe investment. It is not. So that's what I have to say about this. And finally, to end, can I have some gold for diversification? Well, you can if you want to, but how much will you have? 10%, 15% is not going to make a big difference. If you are going to have 10%, 15%, you must be ready to do asset allocation. You must be ready to do, you must be ready to do rebalancing. Most people who buy gold are not ready to do any rebalancing because they are worried about taxes. Then what is the point of buying gold? Then you are better off without that gold at all. If you must, for some reason, if you are somehow compelled to have gold in your portfolio, make a equity oriented multi-asset fund a central component in your equity portfolio. Then you will have a little bit of gold. The fund manager will take care of the rebalancing. So, and you must understand, like I said, gold is not a hedge against inflation all the time. Sometimes it will be, sometimes it will not be. Don't confuse having physical gold, which can protect against a fall in INR value, a huge fall, not small falls. Small falls, gold will not help you too much. Only for a doomsday kind of scenario, gold will help you, but how much gold will you have? So don't go by this hedge against inflation logic. It absolutely makes no sense. It is not a constant hedge against inflation. If you want a slice of the shiny metals return, then you must be prepared for the risks. Most investors are not prepared for the risks. If you are not prepared for the risk, don't buy it. Don't complicate your life.